we are going to discuss the calculation of interest on drawing today. In the previous video we had discussed calculation of interest on capital. Now what do we mean by drawing? Drawing is the amount withdrawn by partner or partners for their personal use. Okay, now drawing can be against profit or drawing the capital can be withdrawn. If they are using the word drawing, it means drawing against profit. Okay, the amount withdrawn in cash or kind in anticipation of profit is known as drawing of partners, and if the term drawing is there, that means it is drawing against profit. If partnership deeds so provide, interest on drawing is charged from the date of drawing to the end of the year. If partnership deed provides for providing interest on drawing and the rate of interest on drawing is mentioned, in that case only interest on drawing will be allowed or charged. Otherwise, in the absence of partnership deed or if the question is silent, interest on drawing will not be charged. Okay, last statement you see. If question states drawing, it should be taken as drawing against profit. So on this drawing, interest on drawing will be calculated. If it is capital withdrawn or drawing against capital, then interest on drawing will not be calculated. On that, interest on capital will be calculated. Less interest on capital will be calculated. Journal entries. First, when interest on capital is allowed, partners capital account or current account, depending upon the partners capital account method we are going to follow. If it is fixed, then current account will be debited. If it is fluctuating, then capital account will be debited to interest on drawing. Okay, narration will be interest on drawing charged. Then interest on drawing account will be closed by transferring to P&L appropriation account. So for that, the entry will be interest on drawing account debit to P&L appropriation. Narration will be interest on drawing transfer to P&L appropriation account. See, I am repeating the journal entries. When interest on drawing is charged, partner's capital account will be debited or current account will be debited and interest on drawing will be credited. To close this account, interest on drawing will be debited and transferred to the credit of P&L appropriation account. Now partners may withdraw for their personal use in different manners, different amounts at different time intervals or equal amount at regular intervals. Okay, if unequal amount is withdrawn at irregular interval, then we will be using the product method or simple interest method. Second, when the same amount is withdrawn at regular interval, in that case average profit method will be used. We will be discussing both these methods in the coming slides. Okay, first, unequal amount is withdrawn at irregular interval, we use simple interest method or product method, and when equal amount is withdrawn at regular interval, then average profit method. Now see, in this slide we will discuss the calculation of interest on drawing when unequal amount is withdrawn at irregular intervals. Interest on drawing is calculated with the help of simple interest method, simple method or product method when unequal amount is withdrawn. Okay, let's take one example for that. I think most of you know the simple interest formula, principal into rate into time. Okay, so that is the formula which we are going to use here. Now the partner X had withdrawn on 1st Feb 4,000 rupees, on 31st May 5,000, on October 1st 3,000 and on December 31st 2,000 rupees. The books are closed on 31st March. Okay, the books are closed on 31st December. The books are closed. Okay, So from January to December we have to calculate the time. It's calendar year, not financial year. Okay, simple method. See, okay, the table is here. The date of drawing 1st Feb, amount is 4,000 rupees. From 1st Feb to 31st December it is 11 months. So 4,000 multiplied by 12% into 11 upon 12, it will be 440 rupees. Next drawing is on 31st May, 5,000 rupees. So from 31st May, if you count, okay, you will be counting from June. 31st May will not be included. So June, July, August, September, October, November, December, 7 months are there. Okay, 7 months. So 5,000 multiplied by 12 upon 100 into 7 upon 12, it is 350 rupees. Then the next drawing is on 1st October. 1st October will be included. Okay, October, November, December, 3 months. So 3,000 into 3, 9,000 rupees. Okay, on the 3,000's 12% at the rate of 3 months is 90 rupees. So total interest on drawing is 880 rupees. Okay, again all of you, from 1st Feb to 31st December, 11 months. 31st May to 31st December, 7 months. From 1st October to 31st December, it is 3 months. And from it is 31st of December. Okay, make a correction here. So it is 0. It is 31 December. So 0. So the anything multiplied by 0 will be 0. So no interest for the last drawing. So total interest on drawing will be 880 rupees. Next, product method. Same question. Okay. 1st Feb, 31st May, 1st October, and this one is 31st December. Okay, so that's why we are taking 0. Make the correction here. 4,000 into 11, 44,000 rupees is the product. 5,000 into 7, 35,000. 3 into 3,000, 9,000 rupees. Total is 88,000 rupees. On this 88,000 rupees, at the rate of 12% for 1 month. Okay, we will calculate for 1 month because we have converted the total amount into a monthly equivalent. Okay, so 88,000 multiplied by 12% for 1 month. Okay, it will be 880 rupees. See, in both the cases, in the first method, simple method also, and product method also, the rate of interest was 12% and the interest on drawing amount is 880 rupees. So you are free to use any one method. Okay, whichever you like, you can use that. The answer will be same. Now calculation of interest when fixed amount is withdrawn at regular interval, like 2,000 rupees in the beginning of every month, 5,000 rupees at the end of every month. Okay, like that, either every month the amount is withdrawn in the beginning or end, or every quarter or every 2 months. So at regular interval, same amount is withdrawn. In that case, the formula used will be interest on drawing is equal to total drawing. If every month the amount is withdrawn, then say 2,000 rupees, so 2,000 into 12, it will be 24,000 rupees. If every quarter the amount is withdrawn, then there are 4 quarters in a year, so 4 into the amount of drawing. Okay, in the same manner, if every 2 months, then 6 times it will be multiplied. Rate of interest and average period. Average period formula we have to discuss just now. Now see, the average period formula is time left after first drawing plus time left after last drawing divided by 2. Okay, time left after first drawing plus time left after last drawing divided by 2. That will give you average period. See, we are taking one example. Okay, the amount is withdrawn in the beginning of every month. Say calendar year. Let's take calendar year to understand average period in a better manner. On 1st January the amount is withdrawn, like that 1st Feb, 1st March, 1st April, and the last drawing will be on 1st December. So first drawing is on 1st January and the last drawing is on 1st December. So time left after first drawing will be 12 months. Okay, here we have written 12 months, and on 1st December the last drawing is there. So from 1st December to 31st December it is 1 month. So 12 plus 1 divided by 2, you will get 6.5 months. Okay, again all of you go through that. Average period if the amount is withdrawn in the beginning of every month. So the first drawing will be on 1st January. So from 1st January to 31st December, it's 12 months. The last drawing will be on 1st of December. December is the last month. Beginning of every month means 1st December. So 1st December to 31st December, it will be 1 month. So 12 plus 1 divided by 2, 13 divided by 2, you will get 6.5 months. Next, similar example, okay, at the end of every month. Okay, in the question it is end of every month. So 31st January, from 31st January to 31st December, it is 11 months. Okay, and the last drawing will be in the month of December, 31st December to 31st December, 0. So 11 plus 0, 11 divided by 2, it is 5.5 months. Similarly, let's take one example of quarter, each quarter, end of each quarter. So from 1st January to 31st March will be the first quarter. So end of the first quarter will be 31st March. So from 31st March to 31st December, it is 9 months. Then the last quarter will be from 1st October to 31st December. The drawing will be done on 31st December. So 31st December to 31st December, 0. So 9 plus 0 divided by 2, you will get 4.5 months. Average period calculation, please learn that. Go through these 3 examples properly. In the book more examples are there. Go through that, and any problem you can message me. Now see, let's take one example. Interest on drawing of A and B at the rate of 6% for the year ended 31st March. Here it is calendar year. Okay, A withdrew rupees 6,000 in the beginning of every month. So 6 into 12, it will be 72,000 rupees. B is withdrawing 5,000 at the end of every month. So 5,000 into 12, it is 60,000 rupees. So in first case, A's interest on drawing or interest on A's drawing will be, total drawing is 72,000 rupees. Rate is 6 upon 100 into 6.5. Average period will be 6.5 because it is in the beginning of every month. The amount comes to 2,340 rupees. See, it average period is 6.5. Total drawing 6,000 into 12, 72,000 rupees. So for on 72,000 at the rate of 6% for an average period of 6.5, the interest on drawing is 2,340 rupees. B, the formula is same. Total drawing into rate of interest upon 100 into average period upon 12. Total drawing is 60,000. Rate of interest is 6 upon 100 into average period. End of every month is 5.5. So amount, interest on drawing amount is 1,650 rupees. Again I am repeating, 5,000 into 12, 60,000. Rate of interest is 6%. Average period, in the previous slide we have discussed, it is 5.5 upon 12. So when we calculate, we get interest on drawing on B's drawing rupees 1,650 rupees.